Hello and welcome to another episode of ZEP Learning with myself, Zane from ZEP Finance. What I'm talking to you about today is just some simple terms that you might need and to understand during the buying and finance process. So the first one would be variable loan. So a variable loan means that the interest rate can move at any time, but it also goes down and you have a lot more features with a variable loan. A basic variable loan is a product where you often don't get as many features as if you're under a package, and then with that you're often just paying low fees and there's often quite a good interest rate. A package loan is where you'll give the lender an annual fee, and in return for that annual fee you'll often get more features with the product. So it could be the ability to have fixed or variable splits. It could be that you get a credit card with no annual fee. It could be that you get bigger discounts on the variable loan, or it could be that you're allowed to have offset accounts or multiple offset accounts. Redraw. Redraw is where you have paid extra money onto a loan and then you're able to take that money out or redraw those funds at a later period. Offset is basically just a term for any savings you have in a bank account that has an offset feature is then reducing the interest on the loan. So it is offsetting the interest of the loan. A fixed rate means that for the fixed term, you have locked that rate in and it cannot change. Rate lock. Rate lock is where a fixed rate is normally not locked in until the day of settlement. So if you apply for a loan, get approved and settlement is 3 weeks later, the fixed rate is secured at whatever the fixed rate is on the day of settlement. A rate lock is a fee you pay to the bank to guarantee that fixed rate from the time the application goes in until settlement. So it means that the rate can't change. If it goes down, you often get the lower rate. Genuine savings is funds that you have built up in an account for a minimum period of 3 months. Most lenders that require genuine savings will need that to be a 5%. If you get gifted funds, that will have to sit in the account for a minimum of 3 months. Equity. Equity is the money, or I guess the amount of the house that you own. So if you have a $500,000 house and you have a $400,000 loan, then your equity in that property would be $100,000. Principal and interest. Principal and interest is a type of repayment where you are reducing the loan balance over the period of time. At the start of that term, you'll be paying a lot more interest and less money off the loan. As time goes on, you'll be paying less interest and more money to reduce the principal. Interest only. Interest only is where you are not paying and reducing the loan. You are just paying each month the interest that is due on the loan. A split loan. A split loan is where you have the ability to have two accounts under the one loan. So you might have one portion of the loan that is fixed and one portion of the loan is variable. Or you might have one portion for another reason, but that would be a split loan. Lender's mortgage insurance. You may hear this called LMI or mortgage insurance. Is a risk premium you pay for not having a 20% deposit that you can go give to the bank to secure the loan. Conditional approval. Conditional approval is where the bank has conditionally approved the loan and you still need to give them additional information before they will give you an unconditional approval. So the conditions could be that you still need to get another pay slip, you need to show better savings. A pre-approval is where a conditional approval but you still have not found a property. So a pre-approval, you know that you have access and you have the ability to lend that amount of money, but the lender still needs to confirm that they're happy with the security that you're buying, so the property that you're buying. So the normal conditions would be confirmation that the valuation of the property is correct and making sure that nothing else has changed in that time. Most pre-approvals will last for 90 days from the date that it is issued. Unconditional approval is where the lender has agreed to that loan and it is approved. So that is where you would normally exchange contracts in New South Wales or take away the finance clause in other states. At this point, that is where you would also start to get loan contracts made up and then you would sign the loan contracts. Thank you for listening today, and hopefully you've got a lot more knowledge about the buying process. As always, we're there to help you out, and our website is a wealth of knowledge. We have the Learn tab, which has downloadable fact sheets, repayment calculators and a blog, and the Videos tab with tons more videos for you to watch. Thank you for listening and watching today, and I look forward to talking to you all soon.